Hello and welcome, folks, to the Shortfall Show Live. Let's see if we got some sound here. And it looks like we have some sound here. Hello. Yes, we do have some sound. All right. Well, the way you stream has kind of changed a little bit, so just kind of getting used to the new setup here. I had some technical difficulties yesterday. It was really embarrassing because I thought I had clicked the stream off for a second, and anyways, we'll get to that later. You are watching Vic's Crush channel on YouTube, and my name is Dave, coming on today for Vic's Crush. See how I did that? It makes it sound like there's like several other people involved in this business, and you just happened to get me today. So I wanted to come on and give you a position update. Now, there's been a couple times where I've come on and said, oh, I made so much money, and I sound like a lot of other YouTubers, because most YouTubers come on and tell you how much money they made. But the only reason I'm able to do that is because I also come on the days when I didn't make money, and I certainly didn't make money yesterday, as we had this big spike in the VIX, and also, I did the wrong thing coming into yesterday because I didn't have any ability to take advantage of that spike yesterday because my position was fully subscribed. I was not in cash at all. I was all the cash in this account was devoted to puts in VXX. And so this huge opportunity came with this spike, and I was unable to take advantage of it, which is not a good thing. Certainly not a good thing when you're trying to set an example publicly of how to trade the VIX. This is an example of what not to do. I was fully subscribed, and I didn't bail out of my position and lock in any losses yesterday, which is good. We can see right now stuff is back down. But on the other hand, I missed a golden opportunity because I had already used all my bullets before. And if we actually, let's go to the chart here and look, and you can see that, I lost all my bullets at basically the dead bottom of the VIX. If we pull up the VIX here, and let me get out of the way. If we pull up the VIX, we can see that, and actually even just the VXX chart, we can see that, I've had a short on for a while, but still there's no excuse to have, this is the all-time low here of 16.1, and I'm fully subscribed. I'm fully short right here at the all-time low. So you get this big pop all the way from 16 to 19, huge opportunity to get short and add to a position here, and I can't take advantage of it because I'm fully subscribed. So big mistake by me here. Obviously, people are going to make mistakes trading. You got to just throw those tickets over your shoulder and move on and try to and learn from it. But this is a big mistake here by me. I shouldn't have been fully subscribed. Actually, I bought one extra put to lower the cost of my cost basis. That's all I had to buy. And I actually considered putting more money in this account to take advantage. But the thing is, it takes 5 or 6 days for the money to clear, and it probably wouldn't have been worth it. But my whole position is just one strike right now, and I'll show it to you really quick. It's the September 8 puts, right, in VXX, which is very aggressive. I don't suggest you follow me over the cliff. The market right now is 15-cent bid at 22 cents. So basically, the world is viewing these puts as essentially worthless. I paid an average of 28 cents for these puts. Now it's showing them valued at about 18, 19 cents. So almost cut in half what I paid for them. But there's plenty of time, 289 days left. But, I had a chance, a golden opportunity here to, if I had only put half the position on, I could have lowered my cost basis significantly by buying more of these puts yesterday, but I messed it up and I was fully subscribed. So learn from my mistakes. Leave cash on the side, especially when we've been going down for weeks and weeks and weeks, and we all knew that there was a potential for a spike coming up soon, and I kind of blew it here. And the problem with, you might say, okay, well, the market's back up now, volatility's coming in, no harm, no foul. You didn't lock in a loss. But the thing is, there's only so many opportunities in life when someone gives you an opportunity to make money. And, we all have considerations here. We all have families. We need, just learning to survive in this world is hard enough. And if you don't take these chances, you don't take these opportunities when they're given to you, they might not come again. And you might find yourself bounced out of the opportunity to even have a trading account. Who knows, something bad could happen and my capital could disappear. And this could have been the difference of me staying in business or not, and I blew it. So I'm not going to beat myself up too hard on this, but you need to learn, fool me once, okay, but, I don't want to be coming back in another month and having happened again. And, even me saying having happened again is using a passive verb. This, a trading account is completely my decision what to do. And with that freedom comes the responsibility that it's completely my fault that I did not leave bullets on the side. And it's just really setting a bad example. So hopefully I can redeem myself by showing you what I did wrong here, which is you don't want to have zero cash in your account and have it all committed, especially when you're at the dead bottom of volatility here and with the VIX at a low point. All right, so let's move on from that. Let's take a look here at where we are, and we are in a good spot. I was watching. Now, we can't always tell what moves the markets, and we never know for sure what moves the markets, but I was watching a press conference from London this morning with the president and Angela Merkel, and I believe that we rallied based on the comments from the president, both regarding NATO and regarding China. Excuse me. And, this spike looks like at this moment that it's turning into a typical spike that lasts less than 48 hours. Let me get out of the way, and you're going to see the chart of the spike here. This is a chart of VXX, but any volatility ETP is going to look similar. Here's UVXY. Looks very similar. Here is, let's check out some of these new ones that we haven't looked at as much. VIIX. But VIIX split at the same time TVIX did, so it's going to look a little wacky. Here's TVIX. And if we just go to TVIX to just like the 1 or 2 days, that's going to give us a better view. Like this is going to just show us post-split. But you see TVIX, up $10, and then back down almost $10 off of there. Now, I was watching the action this morning, and the VIX has been moving lower. If we focus in on actually just the VIX and the futures, now it sounds kind of counterintuitive here, but right now I would rather have the futures line up in steep contango than have I'd rather have the futures line up in steep contango than have VXX move lower those particular cents today. Now, it certainly has moved lower today, but if we can have the term structure line up in steep contango as opposed to VXX moving lower, we know that VXX moving lower might just be a temporary thing, but having the futures line up in steep contango is something that will, anything lost from the decay from us being in steep contango is gone forever, and thus is, sort of putting money in the bank to moving stuff lower. It's like as the VIX moves up and down, VXX moves up and down, but contango losses make it slowly move, in reference to where the VIX is, make it slowly move lower. And let me give you a brief example of this. What I'm going to do here is I'm going to chart. Well, we'll stay with the futures for a second. So you can see here the VIX down 151. VIX futures down, the front month future not down nearly as much as the VIX. VXX not down nearly as much as the VIX. This is the term structure getting back to normal, extending again. The VIX moves way lower. Futures don't move as much down as it, but the thing is we're putting shock back in the shock absorbers now. When you get the VIX moving away from stuff, you create some distance between the spot price and the front month futures. Now there's a buck back in the roll yield, the difference between the VIX and the front month future. You can see the VIX 1445 and the front month future 1542. So there is, you're putting back space in the roll yield, and this is putting back potential for this stuff to move permanently lower, and the relationship between the VIX and these ETPs to permanently move lower. So what I mean by that is, with the VIX 1452 a month ago, VXX might have been 1963. Now, a month later, it's 1760, and it's slowly moving lower in proportion to the VIX. And you will see the price of VXX move lower than the price of the VIX at some point soon, and it'll pass through the price of the VIX and move lower than that on its way down towards zero. And at some point, VXX will split like TVIX and VIIX as the price moves lower. But what we want to see is, for me, since I have a long-term position on, I would rather see the distance between this front month future, this one that says VXZ19, that's the December VIX future. The next future there, VXF20, is the January future. I'd rather see the space between these futures expand. In this case, the December future moved down way more than the Jan future, then actually see VXX move down now, because the farther apart these two get, the more decay from contango is going to reflect itself in the whole term structure, and thus the more this VXX is going to decay based on contango, and those losses are gone forever and is going to permanently move VXX lower, which is what we want over time, is VXX to move permanently lower. Now, I want to chart for you the relationship between VXX and the VIX, and you're going to see with your own eyes this decay happening. So let's do that. So I'm going to put up the other display, and I'm going to try to make this chart as big as possible for you. And we're going to do a very simple study. So what I'm doing is making space here. I'm going to go up to the top of the screen. Let's see. And it's kind of out of the way. Let me pull this down a little bit just so you can see what I'm doing here. So I'm going to go to the top right corner of the screen where it says Studies. I'm going to click Studies. I'm going to go to Add Study. Then I'm going to go down and select Compare With. And then I'm going to go to Custom Symbol. And I'm going to pick the VIX. So this is going to compare the price of VXX to the VIX. So we can see here back. All right, so we can see here. Back here we had with the VIX down here at 14. If you look on the left side of this screen, you're going to see these numbers. These are prices in the VIX. If you look on the right side of these numbers, and actually I'm comparing, this is wrong. I'm comparing the wrong thing here. VXX. All right, that's a little bit better. I got the right chart up. All right, so if you look at the far left side here, you're going to see prices for the VIX, and if you look at the right side on the axis, you're going to see prices for VXX. So if we look back here to, and I'm going to just change the dates here a little bit. Let's go to 180 days. So if you look back here a ways, hold on one second. Custom time frame. All right. So let's go to 90 days. Two hours. Let's try that. All right. So if we look back to October with a VIX 15, right there, VIX 15, VXX was trading like 21. Okay. Now here with a VIX, let's take a look at where the VIX is right now. VIX right now is 1427. Okay. With a VIX with the VIX 1427. This is trading 1751. So it's gone way lower. If you go even just back to the end of October, VIX 14, with the VIX 14 here, which is lower than it is now, this thing was trading 20. Okay? And you move, that's the beginning of November. So basically a month ago. A month ago with a VIX 14, this was 20. Here with a VIX 1450, this is 1745. So it's down 2.5 points. VXX is 2.5 points lower now with the VIX a half point higher. And this is due to the decay. You can see the price of the VIX converging, and I was saying just a few minutes ago, we'll see VXX go below the price of the VIX pretty soon. And you can actually see it right here. It happened briefly on the low a couple days ago. We had VXX 16 and the VIX was like 1650, 17. But then it only lasted briefly, and then or actually this whole area here, let's see, all right, it crosses it right there for a second, and actually it's crossed it here too. So we already did cross it, so I don't know what I was talking about. But this whole time here, we had VXX higher than the VIX, and then as its value decays, now all of a sudden it's lower than the VIX, and it's crossing back and forth, but it's just slowly decaying. But if you look at the VIX here, the VIX is not slowly decaying. The VIX is going up and down and maintaining a range. But these products are slowly decaying. So if we back this up even further, the thing is as we back these charts up, it's going to realign the chart so it's not so far out of whack. But you can see this slowly decaying and coming towards the VIX here. And we can take another example here. Here, VIX 16, or VIX 1572, and this thing is all the way up at 24, right? We didn't hit anywhere near 24 yesterday. The highest we got to was 19. And you can see the VIX popped all the way up to, it's showing, let's see. It's showing the VIX popping up here to 19, and this thing getting up to, like, I guess the top was 19 with the VIX a little bit higher than 19 there. And then if we move back in time, we can see with VIX 19 here, this thing was 26 back in August. So we've really decayed by dollars and dollars and dollars over a brief period of time. And as I said, day to day for me, I would rather see VXX hang up here. Right now, VXX 1745. I'd rather see it hang out up here and have this contango build, because every day that we stay in this steeper contango, this thing's decaying more and more. And it's going to get to the point where even if the VIX stays at like 15, VXX is going to start to move lower and lower and lower and lower. You can see right now as vol comes in, the VIX is moving way lower than VXX, right? But VXX will go ahead and catch up with it again, move through it, and then you'll never see VXX higher than the VIX again until after it splits at some point soon. But yeah, we've gotten a nice rally today. Let's take a look at the E-minis for a second. And this looks like a typical one-day spike. Now, we'll have to see if this rolls over. This could certainly roll over, but we're certainly looking better than we were, yesterday with a big pop back up here. Let me erase this study because we don't need this study anymore. Remove all studies. And we'll go back to like a 5-day. So that's what we're looking at for a chart. VIX is a derivative product, and so I'm going to go back to my charts of the major indices, which are really telling the story of what's going on here. And we've made back to where we were on Monday now. and we'll have to see what happens here, if this stuff rolls back over or what. But in the meantime, VIX has come back in. We did end up yesterday with like an 8% contango, and that's still a good decay. Let's take a look here. I'm just going to go to Twitter for a second.
And we won't bite, right, guys?
I'm just going to Twitter here for a second, and we'll take a look. And if we look at the VIX Central account, you're going to see that we ended yesterday over 8% contango, which is a good thing. Now, somebody came on yesterday and said, why are you making it significant that it's the exact close why is it significant to you that at the exact close we ended contango? And that person made a really good point. It doesn't really matter if it's on the exact close or not, just that in general, the average contango is higher now. But I just use the exact close just as a point of reference, really. But it says December 3rd, VIX futures contango settles at 8.32%. So we lost some contango, certainly. We were up around 14, 15% just a couple of days ago, but 8% is still good. I mean, this 8% here, you might think of like, oh, 8%. Well, I'll get to your question, Spence, in just a second. Thank you for coming on and watching and asking it, but I'll get to it in just a second. When we see this 8% number, that is actually, we're used to seeing percentages in like yearly percent, like, oh, the Dow, went up 20% this year. This is 8% per month, okay? So if you want a yearly percent, you're going to multiply that 8 number by 12. So this is saying that, this is decaying this stuff 96% per year here, okay? 8%. So this is a big number. And any move in this number up, it is very meaningful because you're basically multiplying this by 12 for the year. How do we lose contango? All right. How do we lose cotango? I'm assuming you mean contango. So, all right. So, thanks for questions. No, I see you spelled it wrong twice, so I'm just going to, you probably know that you did that, but I'm just going to show you the correct way to spell it. Contango, C-O-N-tango. And we'll go to the VIX Central chart here. Thanks, Brian. That's awesome. All right, so if we go to VIX Central here, the way we lost contango is, and let me make sure that I'm on the right spot. The way we lost contango is just that the VIX moved higher, and as the VIX moved higher, it actually moved up towards these futures, and when it did that, it rearranged the shape of this curve. And contango is all based just on the shape, the curvature between these two futures, 1540 and 1710. So when those futures change their shape, we lose contango. And generally, when we get a pop, the VIX rushes up towards the futures, and this curve tends to flatten out. I'm just making a copy of it here so that I can write on it. But as we get a pop, this curve, it tends to flatten out, go to more like that. The whole thing shifts up, and it flattens out. And as that flattens out, this contango number lessens. This got down to 8% yesterday. Now what's happening is, as the general market rallies, the spot number has gone way down, right? I can't draw. Spot number's gone way down. This whole structure extends. So it was more like that before, and now everything moves down, but this future here moves down more than the other ones. If we look on our live screen here, we can see this future. Wait, where did my little thing go? Hold on one second. There we go. Let's erase this stuff. When we look at our screen, we can see that this front month future is down 98. down 98, whereas this future here is only down 67. So what does that do? That creates a situation where, like, when we make the contango calculation, this contango number is higher. Now, what is the contango calculation? Well, we're taking that 17.1. We're subtracting the price of this other of the front month future from it, minus 1540. You like my freaking little kid writing here? And then, so 1710 minus 1540, which is equals 1.7. So then we're so these two subtracted from each other equals 1.7. So then we're taking 1.7 divided by 1540. 1.7 divided by 1540. And if I want to be really cool, since I grew up in Europe, I would put like a little slash to the 7. That's like a Euro thing. So if we do that math, 1.7 divided by 15.4, surprisingly, you get 11 here. You get 11. You get this number here. It's actually 11.39. 0.398, which is rounds up to 11.4. So as this, if this were to flatten out by 50% and look like that, then contango would only be like 6%. But what happens is, as this spot price moves lower, either the future just moves down, all these futures just move down to directly to it, or one future moves down and the other doesn't. And remember, the price of VXX and UVXY and all these things are based on an averaging of these two futures. Right now, we are, we'll take a look at it together. If we go to the ProShares website, let's quickly go to the ProShares website. ProShares. And we look at the daily holdings, we can see, all right, so right now we're in the middle of the expiration cycle. The way I can tell that is when I look at the ProShares website here, you can see we've got 27,000 of the D's futures and 24,000 of the Jan futures. So we are just about halfway through the cycle, not quite halfway through the cycle. After today, we'll be halfway through the cycle. And thus, what that means is right now, TVIX, UVXY, VXX, SVXY are based on pretty much an exact mix of these two futures, that 1533 and the 17 future. That's actually moved lower since we were making the calculation. So we're like right here on the chart. Now I know it says December, Jan. These are deceptive on the bottom. What this really means is December, Jan is really just is the Jan future. So December expires. Essentially, this should be where it says Jan should be like December expiration. So right now we're halfway in between these futures. So you could pretty much just take an average of these two. And what does that mean really, that we're halfway between the futures? That means that each future is contributing 50% to the pricing. So if we go back to our live futures chart here, and we look at how the futures have moved. And let's do that real quick. So, all right. So we see the two futures here that we're worried about are this one that says 1524 and this one that says 1690. These are in real time, so they're a bit ahead of that chart we just had. So we see one of these futures is down $1 and the other is down 67 cents, right? So, so 67 cents is 2/3 of $1, right? And $1 is $1. So essentially, in between all these, the average between 2/3 and And a buck is 3/4, right? So if you do your fractions. So the average future is down 3/4 of a dollar. So what does that mean? That means VXX, since it's a 1 times product, should be down about 75 cents. Now, why is it down more? It's down more because of the closing marks yesterday. But basically between 4 and 4:15, something weird happened. But based on the average of these two futures, this should be down about 3/4 of a buck, because that's what the average future is down. Now, TVIX should be down twice that much. So, and percentage-wise, and so whatever the percent is that this moved down, I guess I'm explaining it wrong. Like if we look at the VIX, right, it shows it down 9%. If we look at the front-month future, it shows it down 5%. Second-month future, it shows it down 3.7%. So like 4 and 5%. So if these are down 4.5%, then VXX should be down about that same percentage, 4%, and it's down 5%, so it's close. And TVIX should be down about twice 4.5%, or 9%. So let's look at TVIX and see how much it's down. It's down a little bit over 9%. So it's and UVXY should be down 1.5 times that percent. So we're saying somewhere in between, halfway in between the percent that the first future is down. So the first future is down 6%. Second future is down 3.73%. So if we add 6%, 6 plus 3.74 is 9.74. 9.74 divided by 2 is 4.87. So the futures are down an average of 4.87%. So the 1 times product should be down 4.87%. And if we look at VXX, yeah, it's down 5%, so just slightly over that. If we look at TVIX, it should be like twice that, which is going to be about 9%. And we're seeing TVIX 10%. So when people say, "Oh, it's a scam. This isn't right. It shouldn't. This isn't working right." If you were to just look at the VIX here, you'd see the VIX down 10%. You'd say, "Oh, with TVIX, that should mean TVIX is down 20%." No, it shouldn't, because TVIX is not based on the VIX. It's based on the futures. So what you need to do is figure out where we are in the cycle and figure out which future is affecting things more. Right now, they're equally affecting things. So if we take an average of the percent that these futures are down, that's going to give you your basis to calculate, okay, the average is around 5%. So VXX, which is a 1-time leverage product, should be down somewhere around 5%. TVIX, which is a 2-time leverage product, should be down somewhere around 10%. And we're doing that math based on the VIX futures, not on the VIX, because although the VIX is central in understanding all this stuff, all these products are based on these VIX futures. So when someone says, "Oh, this is a scam," you're going to see somebody, I guarantee if you go on StockTwits today, that's going to say, "Oh, this is a scam, manipulation. The VIX is down 10% and TVIX isn't down 20%. What a scam." And you can say to them, no, it's working just the way it should be, because when we calculate out the futures are down about 5%. TVIX is down about 10%. So it's right in line. And the thing is like there's no wiggle room with this stuff, because it's all based on a formula. It's not like there's guys out there with this fund that are like moving stuff around. If there were some funds like that, VMIN, for example, was a fund where there was some discretion, where the people running the fund could do, they could kind of trade it the way they wanted to some extent. But these products like TVIX, VXX, UVXY, they're based on a formula that follows a specific index, and they stick to it there's no wiggle room. They don't like trade it one way or the other. So there's no, you can always do the math and figure out where it should be. And so when people come and tell you, oh, it's a scam, you're armed with this. You know better. You know that it's based on the futures, and you can do the math pretty quickly to figure out what's going on with the futures. VC analyst, how's it going, buddy? Hey, what's up, Edward? Geez, like I've been waiting to come live to see Edward the whole time. I missed you last time. Nice to see you. Welcome back, Hubris. All right, so VC analyst. So what happened with your? I want to know what happened with your DEES puts. It was, which one was it? DEES 18 puts. Did you end up bailing on some of them? Did because I know that we talked about 2 days ago and things got reasonably worse yesterday, but things have come back a little bit today. Yeah, what's up, Edward? Thanks so much for all your support and kind words and everything. It like definitely like helped me like get through these tough times with the being banned and all that. All right, please these people to understand that ETPs are not based on the VIX but on VIX futures. Yeah, so to get back to our discussion, these are based on the VIX futures. However, everything's derived from roll to Jan puts. Well, that's better than puking out completely, right? Everything is derived from something else here. So you've got really the E-minis and the SPX which are controlling the game here. If this stuff continues to rally and take out the all-time highs, the VIX is definitely going to move lower. You've got the VIX spot, which is what everybody's watching, but is not directly tradable. VIX ETPs, it's a little bit confusing, and I've had this wrong before. Hey, what's up, Sean? VIX ETPs, when we're thinking about rebalancing at the end of the day, and let me come back on the screen here. When we think about rebalancing at the end of the day, and I'm sure people will correct me if I get this wrong, when we're talking about a leverage product, like let's say VXX, which doesn't have options on it, so I don't trade it, but it's a good example here. A leverage product, what happens at the end of the day is that they need to rebalance a leverage product so that it will have the leverage it needs. So thus, like if you have a TVIX, it's trying to make two times the move in the futures every day. So if it moves up a lot, they can find themselves in a situation where they don't own enough futures. So they have to come into the market and buy futures at the end of the day. Or they don't always actually come into the market and do it. They can do it through swaps. They have tricky ways to kind of get around this stuff a little bit. But the bottom line being, with a leveraged product, you need to rebalance the number of futures you have long or short, or essentially it's long in this case, to reflect that leverage. And when you've got a situation where it goes up a lot one day and you've got to buy extra futures so that you still have that leverage, then it goes down the next day while you've got to sell out some futures so you still have that leverage, and you end up what traders call negative scalping. So let's just say theoretically you have to buy a bunch of futures paying 16, and then the next day when it moves down, you got to sell those futures that you paid 16 for. You end up selling them out at like 14. And the more times you do that, the more these things are going to decay. And we call that kind of decay beta drift, okay? And they're going to use the closing prices, depending on the formula for an individual product. They're going to use the closing prices to decide how to rebalance them for leverage purposes. This is a beta drift can make the thing, in many cases, it makes these decay, but in a certain, if the pricing takes a certain path, beta drift can actually increase the value of these products. Now, there's some good videos on YouTube that discuss beta decay or beta drift specifically, and I will make a link to some of these I will put it up in the description after this video comes out. I don't want to waste your time by going and searching for them right now, but this occurs not only in VIX products but in other products like your UGAS, DGAS, your miners, your JNUG, NUG, and other leveraged products like TQQQ, TQQQ, and but this is distinctive from contango. Contango, although we tend to think of it like, okay, they're rebalancing everyday futures, they are moving futures around, but for a UVXY, it is based on an index, and the index is taking into account the relationship between the futures and whatnot, but it's not marking the position at a particular time at the end of the day and then readjusting. It's just taking into account the averages throughout the day and the whole time. So because these things are based on an index, essentially the market makers are making a market around the index. So if they see the index is this particular price, they're going to make a market around that index, and thus it's kind of updating all the time throughout the day. And so you want to make this distinction between the decay from contango, which is basically just the average throughout the month, and it's kind of like dynamically updating based on this index, and the decay from beta drift, where it really doesn't matter if, today it's up $2, the next day it's down $2. That's really going to make a serious difference over time for decay on beta drift as compared with contango, where like what it is at the exact moment at marks at the end of the day is not as crucial as just it maintaining a certain level. I hope that clears it up a little bit, but yeah, search. There's one guy who's done some really good videos on different outcomes for leverage products as the closing prices change from day to day. There's a certain walk they can make where like actually the prices get. When you have a leveraged product, you'll see people saying, "Don't hold on to this for more than one day." These products are not made to be just like you buy it and put it in your pocket and hold them, because they have unexpected outcomes. They're not geared towards long-term returns. They're geared to make sure that they can get as close as possible to being able to make that 3 times leverage for that one day, for that one period from open to close. And because they're geared towards that, there's unexpected outcomes over long periods of time, and you can get lucky. And I mean, I came to the VIX because my idea was like, all right, so you've got these 3 times leveraged products. They have this beta drift, so they're always decaying. So why not sell both of them? Cool. Yeah, if you want to post that video actually in the comments section, that would be cool, Edward. But my idea was like, all right, you've got these 3 times leveraged products. Why not sell both of them? And they're just both going to decay eventually, and you don't have to be right on direction. You just sell both of them. And I was reading articles in Seeking Alpha where people were saying, don't do that, because the problem with selling both of them in that situation is A, it takes a lot of capital to be short these things, and B, you need to have an equal weighting on both of the ones you sell. Otherwise, you've got this risk, delta risk, where like a move in one direction, you're not delta neutral, you're not flat directionally, and you've got to readjust how you're flat directionally all the time, and it's going to take up so much capital that it's not going to be worth it, was the conclusion of this guy on Seeking Alpha. However, I don't really take one guy's conclusion as the gospel, and I think there are ways to sell these things and make money. One way would be just to sell kind of like out of the money calls in both products, and then just kind of leave it and let it sort of ride. Because if you're selling out of the money calls, maybe the capital requirements are a little bit less. You could even sell out of the money call spreads. But anyways, that's kind of how I got to the VIX, was investigating this, what we might call beta drift. But in the end, contango is really what is really giving these things that extra bang, because we've been in this 10% plus contango thing for a while now. And like I said, that's 10% per month, not per year. And it ends up being huge over a while. I just want to go back to VIX Central for a second and illustrate that. If we do go to VIX Central here and you go to contango, it's going to show these two lines, and I'm going to get rid of the F4 to F7 one and just look at the front month ones, because the front month relationship is really what's driving all these ETPs. And if I isolate just this last little section here, and you guys have seen this before if you've watched the show, everything above this red line is in contango, and that means that these products are decaying over time. And the decay, once again, doesn't happen because of sort of a rebalancing at the end of the day. Decay happens because simply as the futures fall towards spot every day, the futures are slowly falling towards spot as these things converge. And most of the time when we're in a normal situation, the futures are above spot and they're falling towards spot. And over time, essentially what's happening, it's not mechanically happening, but it's happening through the index, is that these lower price futures, these 1527 ones here, let me get my little clipboard out here again. What's happening over the course of the month is that these futures down here, 1527 ones, are slowly being replaced by these ones. So there's not a whole lot of room here to fall. Now, there's a lot more room than there was 3 hours ago or something. Look, there's over a point now between. It's kind of deceptive, because if you look at this chart a couple hours ago, it looks similar, but actually when you look at the actual math, there's almost a point now between spot and the front month future. Yesterday, actually, spot had gone through the front month future and was actually like up here. But now there's actually a full point here between them. And like I say, it's deceptive because the X and Y axes on this are like dynamically changing here. But over the course of the month, all the futures, these front month 1520 futures, are being replaced by these 1692 futures, or whatever the second month is, and it's creating more space for this to fall here. And as more space is created to fall, it is able to move lower. And this falling is what is creating, is what is making these things go lower. So this whole area under the curve, I feel like I'm like some like advanced math guy here. This area under the curve, and I'm sure there's a formula to figure out this area, which is pretty simple, is all the potential. And as time goes by, these futures are essentially being replaced by these futures. Now, it's not like somebody is selling 10 of these futures and taking the money and buying 10 of these, and they have to come up with more money to buy more of these. It's a zero-sum situation here. However, what the end result is, there's more space to fall. It's constantly creating more space for these to fall. And so these futures can slowly be falling forever and never actually get to spot price over time. And as months go by, the futures just get slowly moved up, and they're just slowly always falling towards spot. And as they continue to always slowly fall towards spot, these products just move lower and lower and lower and lower, and they split over and over again and move lower and lower. And yeah, you've got spikes and stuff in the way, but the steeper these things are in contango, the more space is being created for them to fall farther and farther. Because if there was less space here, if the line was more like that, then instead of having this additional amount of space here, you would only have this little amount of space, and it creates less room for this stuff to fall. So we love, for long-term shorts, this contango number. And there's some caveats here. Of course, like right before expiration, the average is going to be somewhere. This second calculation here, which is in between the M2 and M3 months, it's going to come into play in this in this average, in the index that creates the average at some point. And so right before expiration, you'll see this number many times move really high. And it doesn't really represent that these things are decaying that high, because the average is actually going to be slightly lower. But when you're in the middle of the month and you see a number like this means that there is real-time decay. I mean, 10% per month means that this thing would theoretically go to zero over the course of the year if it stays that high. And it is a remarkable number. And this is the reason why I'm positioned the way I am with out-of-the-money puts far out, because 5 months of 10% means that this thing gets cut in half, essentially. Now, as the months go out, you're looking at 10% of 17, then 10% of 15, and it's actually less than 50% overall, because the number's slowly moving lower. But it's still a very remarkable, significant amount that this stuff is decaying. Spence. Spence, you know what? I don't expect you to like absorb all this stuff at once. I just figure if I go through it, it's the kind of thing, it's exactly like options trading. It's like you go through it and repeat it and repeat it and repeat it, and it slowly starts to sink in over time. But I know I'm hitting you with a lot, but if you retain just a little bit of it, then you're better off. I apologize for getting a little complex. Which futures are you trading now? You're trading VIX futures? And you know what? I'm describing here how this stuff decays. And you don't necessarily need to know how it decays to trade it. And it's this mechanism is occurring. You don't necessarily need to completely understand it to know that this stuff is going lower no matter what. But one thing that I would recommend doing is just pull up this VIX Central every once in a while and see how it changes. That's something that would be interesting to you. This is a typical contango shape. If we get a huge spike, you will see this turn into like a smiley face. And once again, if you do pull up, there's some Stephen Aniston VIX Contango videos on YouTube that explain all this stuff. Awesome videos. They've only got like this really small number of views, which I don't understand, but awesome stuff. So check out that. So here we are. And the VIX came in a lot today, down to 1436. I know people, a lot of people lost money that were short this stuff over the last day, but, it's in only 1 day's time, we're back down from an 18 in the VIX to a 14, down 4 points. That is a big move, and some of this stuff should be coming back for you. I had the position on for the longest time where I was long the 2018 put spread in December, and it wasn't looking too good yesterday, but now we're back under 18 again, and the put spread is it would be back to 100% win with 16 days to go. So it's a little scary, but things have come back. There's nowhere in the market, from what I understand, S&P goes down, TVIX goes up. Right. Yeah, TVIX is based on VIX futures. So VIX futures essentially go up when people get nervous. And the basic mechanism that's going on here with the S&P is that there are fund managers who, the average fund manager owns the S&P in some regard or another, whether it's a basket of stocks, buying ETPs and whatnot. And part of the returns they get from being, the average person who's in the stock market owns stocks. And part of the return they get from owning these stocks is from dividends. So when they get nervous, they don't just sell out the portfolio. What they do instead is they go in and they buy put options in the SPX. And when people buy put options in the SPX, that's where the VIX comes into play, because when people buy options in the SPX, those option prices go up, and the VIX formula is based directly on those options prices in the SPX. So when people get nervous, they say, oh, we own this big portfolio, things aren't looking so good. What they do is they go buy protection. So they go buy put options for protection, and the VIX pops up. So that's why they call the VIX the fear gauge, because when people are afraid, they buy puts and the VIX pops up. Now, the buying and selling of things in the SPX is the biggest trade in the world. 80% of the trade in the world is people trading the SPX. It's the hugest component of trading, and it drives everything in the market. Indeed, it drives the VIX. And so when you see people that are charting TVIX or charting VXX or UVXY, or when someone's saying, oh, there's a lot of buyers in UVXY right now, that means that the VIX is going to go higher. That's not really the way it works. The buying and selling of options and futures in VXX or UVXY, or buying the underlying of UVXY or TVIX, is minuscule compared with the trade in the SPX. SPX options and trade drive everything in this marketplace. That's why you want to keep this chart foremost when you're looking at stuff, is the SPX, because this drives the world in the stock market. Maybe it won't be true forever, but it's true right now. Let me get out of the way here. And the VIX is a function of the SPX in that it's a formula based on options in the SPX, strongly related to out of the money puts, which are and we can look at those particular options. It's not revealed the specific formula, so I can't tell you exactly, okay, well, this option counts for 20% or this option counts for 15%. But if we look at out of the money right now, SPX, a little over 3,000, 3,100. So if we look at anything below 3,000 in the puts, here's calls on the left, puts on the right. You don't see a lot of activity here. But there are a lot of different options in the SPX. There's daily options, there's weekly options, there's monthly options. I mean, it's just, there's a ton of different stuff. And there are different products, like there's the SPY, which is, closely related. There's E-minis. But the VIX is a function of people buying and selling options in the SPX. And so if you understand it that way, you can see that these products like UVXY or VXX or TVIX are just products that kind of take a sample of what that price is and move around based on that sample. But in general, now big players will try to be sneaky and do stuff like, instead of going into the SPX directly, they might actually go in and start trading VIX futures, or they might buy options on. If we pull up VIX and we pull up options, this is options on VIX futures. This is a big source of, there's a lot of money that goes through here nowadays. And sometimes, these products have an effect on things because there's so much money going through them. If we pull up time and sales right now in options on VIX futures, you're going to see some size up trades. Here's 9,500 trading. We will see at times 50,000, 100,000 of one thing trading on this stuff. Let's see what we've got here. But in general, the SPX is what fuels everything. And the fact that this stuff is kind of confusing, and that the term structure does move around and doesn't make intuitive sense to everybody, that's what creates the opportunity. Anytime you have something that on the surface is a little confusing, that's where the opportunity is. And people know that it's confusing, and the fact that it's confusing means that not as many people want to trade it. The markets are wider, stuff moves around more. There's nothing, if you have SPX futures or E-mini futures, there's a mechanism that keeps E-mini futures or SPX futures close to the value of the SPX. It's called arbitrage. And so people will buy a basket of stocks and they'll sell the futures if the futures are higher. If the futures are lower, they'll sell a basket of stocks and buy the futures to keep things in line. With the VIX, there's no mechanism to keep these futures like the only mechanism to keep these futures in line is that the futures have to be the same price as the VIX on expiration. Beyond that, these futures can do whatever they want. And there's a reason why they line up like they do here, and it makes sense intuitively if you think about it. Is it more likely that there could be a VIX spike with 30 days to go? Well, let's see. How many days to go do we have here? All right, so this future expires in 13 days. This other future expires in 48 days. Is it more likely we get a spike in the next 13 days or 48 days? I would say 48 days because, Edward, I believe it's also based on calls, the VIX formula. Is it more likely we get a spike in the next 15 days or in the next 48 days? Well, of course, it's more likely we get a spike in the next 48 days. Therefore, it stands to reason that farther out futures would have a higher VIX because there's more time for something bad to happen, essentially. So this kind of makes sense. It also kind of makes sense that for you to buy TVIX or for you to buy UVXY, it's going to slowly decay. If these things didn't decay, then everybody would just buy. You would just buy UVXY, and then you just hold it indefinitely until there's a spike. There's going to be a spike sometime, so you just buy UVXY, put it in your pocket, and as soon as there is a spike, you cash in. And nobody would want to sell UVXY to people. Remember, when you buy something, somebody is on the other side of it. Nobody would want to sell UVXY or TVIX to anybody if it was guaranteed that you're going to get hammered sooner or later on it. These products act like insurance. When you buy an insurance policy, you pay a little bit of money and it protects you for a certain period of time. Then you got to pay a little bit more money. This stuff this operates like an insurance market. You can essentially buy protection for the VIX 1426 here, but if you want to buy it out in January, you're going to have to pay more than 1426. You're going to have to pay 1687. And if nothing happens, then this price is going to slowly decay down to the price of the VIX, and that's this price here. If you think of it in terms of an insurance situation, and I'm getting my little drawing thing out really quickly. So sorry for the delay here. If you think of this in terms of like an insurance thing, then this distance here is like your insurance premium, how much you're having to pay to get that protection for the VIX out to January. And you can make that decision or not, knowing full well that if nothing happens, this price here is going to go down to here, down to whatever the price of the VIX is over that time period. This distance here, though, is the cost of insuring yourself. And so when I'm selling VIX stuff, or even when I'm selling like a call in UVXY or something, essentially I'm selling someone insurance for a crash. And if the crash doesn't happen, I win. If a crash does happen, then the person wins. But the odds are generally in favor of the crash not happening today. Yes, so Spence, exactly. It's just hedging. And it's interesting. They're teaching, VIX is a relatively new thing. I mean, it's really only come about really VIX trading and stuff really has really just started since like 2000. And so we don't know all that much about it yet, as far as like we haven't been through extended down moves on it. And but I'm hoping that it becomes taught more and more in finance. We see my buddy Pat Hennessy. I guess I can call him a buddy. I've talked to him a few times privately. He's been teaching to grad students about the VIX. They're starting to teach this in classes now. So this is becoming more mainstream. And so I would like to see every class. How much did I have to drink? True dog, I don't drink. I'm sober. So I think they're referring to last night. My email had 3 messages from TD Ameritrade saying that that I had an account statement for me, even though, or that I had trade confirmations, even though I didn't trade at all yesterday. At the most, I get one. I don't know if you guys noticed this at all, but actually, I'm not going to pull up my email here, but take my word for it. I had 3 TD Ameritrade things, and this guy, another guy on Twitter, had the same thing. So I'm not crazy and I'm not drunk, but thank you for your concern. What is the best drug to take while trading? Oh, geez. I would say most people would say Coke. Um, I was, I can't, I'm not going to go into names here, obviously, but I was widely criticized as a trader on the floor, being a stoner, being a pot smoker. Like I said, I've been sober since 2008, but the drug of choice on the floor was Coke, I believe, back in the day. I kind of missed the heyday of all that. I got on the floor in the mid 90s. I guess the 80s was. There were a couple times in the 80s. Oh, Adderall. Well, there you go. That's speed. It's close. A couple times in the 80s, they came with warrants for people on the floor, and there was this thing called the belt, which was I'll get right back to your question, VC analyst. There's this thing called the belt, and what you would do is you write up your trading ticket. Let me come back on the screen here. You write up your trading ticket, and there was 3 copies to it, and you take one and you put it in the belt, and it would go down the belt, and then somebody would enter it into time and sales and whatnot. I guess they came and they had warrants for all these people, so traders would take off their trading coat with their badge, and they would hand it to their clerk, and they'd trade jackets with their clerk so that they could get off the floor without the federales coming after them. I have this is like one of my old badges here. This is actually a SIBO quote reporter's jacket, but I used to use those colors too. It was also my company's colors. Yeah, so the belt, people were just like throwing pills and all this stuff in the belt. And, there was a time when, like, if you go in the restrooms, people were doing this stuff, and it was very common. It was a very, very common thing. And like I said, that I'm not going to go into details about it. But I was criticized a lot because, like, I was a pot smoker, and people were like, you're doing the wrong thing. This isn't the thing for the floor. People are, I would say, Adderall or speed or this kind of thing. People were all hyped up. For a while, I was trading for a brief while, I'd say a month or two, I was trading in the 10-year pit at the CBOT, the Chicago Board of Trade, which was bond options. And there was this guy who was always chewing gum at 100 miles per hour. We call him gum chewer. And he was obviously coked up, and he would be like all day. And you could watch him from the side of the pit just chomping on this gum like there is no tomorrow. But people get hyped up. And I get accused sometimes in these videos of being all hyped up. And it's just because I get excited about and passionate about this stuff and talk really quickly. But yeah, I mean, trading can be a difficult lifestyle, because you put a lot at risk. Now, a lot of people online will talk about how, all right, well, you don't want to risk more than like 2% on one trade. You don't want to put yourself in a situation where your account can blow out or you can lose all the money you have. But working on the floor, we're encouraged to take risks. We're in the business of taking risks. They want us to take risk. And thus, we would have it all on the line sometimes. I had positions on where, like, I couldn't sleep at night. I had one where I was waiting on FDA approval for something, and it's either getting approved or it's not. And you just got to wait it out and see what happens. I was short straddles in the stock. It was $30. And it's either going to move or it's not. Other times, I had a friend who was trading BREX mines. I don't know if you're familiar with BREX mines. There was this mining operation, and they pretend they found gold when they didn't. And the stock went to zero at some point, and my friend lost a zillion dollars on BREX, and it was because these people are cheaters and lied Briex mine. Briex. And these cheaters lied. Let's see. Here we go. Briex was a group of companies in Canada. Briex Minerals, a major part of Briex base in Calgary, was involved in a major gold mining scandal when it reported it was sitting on an enormous gold deposit in Indonesia. Yeah. And this guy, they came and bought puts from him. They were paying out the nose for puts, and obviously someone's paying out the nose for puts, something's probably up. But when you're a market maker and this product, the only place it's traded in the world is the SIBO, and there's only 2 of you or 3 of you trading. I think there was probably like 5 guys trading it, and I'm not going to give names here once again. When there's only 5 guys trading it, yeah, you can raise prices, but you got to sell something. I mean, if you're making a market and you're 50 up, yeah, you can raise prices, but you got to sell something. And so, they come and pay $1 for these things, and maybe you sell 20, and then you raise it, maybe it gets all the way up to $2, and then, you sold some at 20, so you want to sell some at $2. So, you sold some at $1, you want to sell some at $2, and this thing collapsed. So here it says, okay, so it went from being a penny stock to trading at 286 Canadian dollars. Now, I know Canadian dollars aren't as high as U.S. ones, but it got pretty high, and it just collapsed in 2003, and my friend lost his ass and was just sitting in the bar. But there's good stories too. I have a friend who went away on vacation, and he said, like, had the bosses watch my position while I'm on vacation. He was long a bunch of options, and they made $2.5 million on his position while he was on vacation. They came back. They're like, oh, yeah, here, we'll hand the reins back to you here, buddy. And, his account was up $2.5 million. They say he takes home we were taking home like 40 to 45% of whatever profits we made after expenses. So the guy takes home $1 million from his vacation. He went on vacation for like a week, and he gets $1 million to take home on that vacation. But the thing is like the risk is extreme here, and you're going to have to decide for yourself what sort of risk that you feel comfortable with. And you're going to see a lot of people would never take that kind of risk. I was a successful trader for a long time, and I made a lot of money. But the thing is that you cannot make a lot of money without taking risk. And once again, you're going to have to decide what you are comfortable with personally. And I would recommend being conservative because you want to stay in the game to trade another day. And until you understand stuff really well, I would be very conservative if I were you. And for me now, when you're a young buck, you don't have responsibilities and family and big overhead and stuff, then, you can shoot from the hip. And I mean, if you think about it, you're not going to be super successful as a trader starting with nothing unless you take some risk. There is a school of thought, and I'm not pushing you in this direction because I think it's irresponsible. But there is a school of thought that, all right, let me work my, work at McDonald's for a year, 2 years, and save up 10 grand, and then go into the market and take serious risk with that 10 grand. If it works out, then I'm off to the races. If it doesn't work out, then I'm just going to go back to McDonald's for another year and a half and raise another 10 grand. And there were a lot of people on the floor that had that attitude. And it extended to okay, I'm going to get a backer who's going to back me with $100,000. I'm going to take a bunch of risk. If it doesn't work out, I'll get another backer. But if it does work out, then I'm golden. And I've seen people go through that. And, back in the gunslinging days of the floor, there were backers who were willing to take that risk. They figured, well, if I give 10 people 200 grand each, I'm putting out $2 million, but one or two of those guys are going to be successful, and I'm going to make that $2 million back plus a lot more. But we're generally teaching people online about trading. Teaching people online about trading, we, it's seen as irresponsible to teach people that way. It's the problem is that it's hard for people to hold their interest if you've got, let's use what Edward's saying here. If you've got $500 and someone's saying, okay, you can only use 2% of that, and you're trying to make 10% a year. So you think of 10% of $100 is $10. 10% of $500 is $50. So you're like, okay, so this year with my $500, I'm hoping to make $50. You're kind of like, well, I could just go out and do a minimum wage job and make $50 instead. It doesn't make sense. You long Bitcoin from $4,000 to $10,000, made a bunch. That is awesome. The thing is with Bitcoin is like people got really lucky. And I had a couple friends who did that too, and were trying to convince me to do it, and I didn't do it, and they made the money and I didn't. And then I tried to convince them to get out, and a lot of them didn't get out. And people had this attitude with Bitcoin like it's going to change everything, and that somehow because they put their money in it, that they deserved their money to go from $1,000 to 200,000 or something like. And it was I actually enjoyed, just from a personal level, watching some of these Bitcoin booster channels where you're not allowed to say anything negative, and people are like, it's going to the moon. I actually enjoyed watching some of that stuff for just comic relief, but just the kind of attitude that well, I deserve to make money. All these people that work real jobs and labor away, well, I deserve to make more of them just because I believe in Bitcoin, was pretty funny. So let's see. I longed. That's a verb. I longed Bitcoin from 4 to 10K. Made a bunch. Slowly lost all my profits. Back to my original cash. Hey, at least you're back to your original cash. It's a bummer that you weren't able to get out, but at least you're back. And you've learned some lessons. You had some fun. I think it's probably a good experience for you. I was going to try to get into Bitcoin mining when Bitcoin was around $1, and I bought one Bitcoin and I lost the thing. So I could have had a Bitcoin for $1, but I lost the hash, and that was it. It's the story of my life, losing hash. Starting with $500, you'll have $1 million in 4 years. That's the other thing is that, and I know Edward knows this, but you see a steady stream of people on StockTwits that will come in and they will get long these products, and then they're gone after a few months because it's very enticing to be like, oh well, you put in a dollar and you make $1 million. You put in $500 and you make $1 million. This is why all these people, I worked for a long time as a side job at a gas station, and people would come in when the lottery, megabucks was X amount, and they'd be like, that's a pretty good deal. You put in $2 and you make 100 million. But the thing is that you don't make 100 million. You just put in the $2. So a lot of trading and a lot of options trading is about odds and expected return. And with options trading, we try to tilt the odds in our favor. Now, I know I'm not talking specifically about the VIX here. My background is as an options trader. And so my level of expertise is combining knowledge about options trading with knowledge about the VIX. So right now, we're just kind of talking generally about the VIX and the term structure and stuff like that. But a lot of these shows go more into detail about options trades that you can make to take certain opinions on what's happening with the VIX. Yeah, they say lottery tax is regressive, and in fact, if you were to chart people playing lottery versus education level, you'd find that there's very few master's degree people or people with PhDs that are putting a significant amount of money in the lottery. Yeah, there's certainly people that will put $2 in the big drawing sometimes just for fun. It's I can certainly justify, like, I put $2 in the big drawing, and it's exciting for me. It provides me with entertainment. It provides me with emotional satisfaction. But a number of people in the United States who put a significant amount of their income into the lottery, into scratch tickets and whatnot, is unbelievable. I mean, I don't know if I can explain to you exactly how much it is, but it's like the average is like thousands of dollars per person. And I watch people that are like, I don't know if you consider them poor or not. Maybe like guys who are career carpenters who make, a decent, maybe make 70 grand a year or something. But they end up spending, it doesn't seem like a lot. If you spend $20 in a day or $50 in a day, it doesn't seem like it's a big deal, because you're like, oh, well, I'm just going to get a $10 ticket with what I'm doing. But if you look at it over a long period of time, it's a huge amount. Why do VIX trading experts getting into vicious arguments on Twitter and YouTube? Well, I actually see some of this arguing as a positive. And the reason for that is this is bringing people to the conversation. This is raising the profile of the VIX, and yet people are not all going to get along. And there are, there's people that are debating this stuff, I think it's good if we're having a debate in public on stuff. It's good that people are just talking about the VIX, because 5 years ago, nobody was really talking about the VIX, and people like Seth Golden brought this stuff into the spotlight with articles that were written up about him in the New York Times, Wall Street Journal, and whatnot. And the VIX has raised its profile a little bit and become something. And I think a healthy debate is good, as long as people aren't vicious with each other. And I don't necessarily, when I know that people get upset about people coming on and being irresponsible and advocating taking certain risk. And, risk management is at the heart of trading. And I think you just have to tell people and explain to people and educate people on what sort of risk are they taking. What is the proposition when they put this certain trade on? What is the risk they're taking? And just like with like drugs or something, like what is the risk you're taking when you drop a tab of acid or something? Is the right thing to make it illegal to have drugs, or is the right thing to say these are adults? When you open a trading account, you have a lot of power to do stuff and to lose money. You have the freedom to make whatever trade you want and lose money. Is it irresponsible of us to put forth strategies that are very risky? I think you just have to really, really be clear with people about understanding themselves and understanding what kind of risk is something that they feel comfortable with. The short vol trade becoming more popular, be good or bad for this trade? This is a common question and I think the kind of thing that you're getting at is, would it be that too many people are shorting vol? Would that make it so that there's it's kind of like uneven? Like, is there only so much opportunity? And would it make it so like stuff is depressed too much and that it blows up in everybody's face? And I mean, that sort of situation did happen in the Volmageddon, where there was just like too much short. But I think of it in terms of risk and spreading risk. The market, we go back to our SPX here. The market is, people own the stock market. There's a risk of it crashing. Some people are willing to don't want the risk of it crashing, so they put it on other people. Now, these leverage products allow the public to participate in taking some of that risk. Thanks for joining us, Spence. And as long as people understand what risk they're taking, these VIX ETPs have allowed the public to take these certain risks easily. Before, you could go open an options account, sell straddles or sell SPX puts. You could do that before. It's just that these products have made it easy for the public to do so. And there was a lot of empirical evidence when the Vomageddon happened that retail traders didn't understand the risk they were taking way too much risk. People were showing screenshots of their accounts being long XIV, and not just long XIV, but margin accounts where they'd borrowed money to be long XIV, and that's their only position, is a leveraged position in volatility, plus borrowed money on top of it onto this position, which is clearly irresponsible and clearly way too much risk. And it comes back to this Voltairean philosophy of, is the public too stupid to make their own decisions? And I say, no, and that we need to, I want to help educate the public so that people can make good decisions. But public is not too stupid to govern themselves, and they're not too stupid to make their own financial decisions. And putting up, I do have some responsibility as an influencer online, but that doesn't mean that I'm forced to limit what I show people to a certain level of risk or not. That's sort of my opinion on this stuff. I certainly don't like this stuff where you're deceiving people by saying, okay, well, we're come on into my volatility boot camp. I'm going to teach you how to make 10% per week. And, this guy and this guy and this guy all made 200% this year and blah, blah, blah. Of course, if you have 10,000 people, a couple of them are going to make these crazy returns. But the reality is it's hard to make money trading. Not everybody's going to be good at it. There's no free money out there. The people that you're competing against are very smart. They're smart. They're wired. They're experienced, and you need to go into a trading situation realizing that it's not easy to make money. Nobody's giving you free money, and when money appears to be free, you got to step back and say, why am I so lucky? Why does somebody want to give me free money? And you got to think twice before you jump in there on something that seems like it's free money. Do you oppose the Warren Sanders proposed tax on market transactions? I fear it will gum up the works. It's funny. They say that there a lot of the market is conservative. A lot of traders are conservative, but there are liberal traders out there. But whether you're on the left or the right, pretty much all traders agree that they should not overregulate the trading market. So I think most people are against increasing tax on transactions. And I have a philosophical and I think a reasonable case to make of why that's bad, other than it just hurts me specifically. It's that same thing where okay, farmers don't want tariffs on farm goods, or farmers want subsidies for farm goods. Everybody acts specifically in their own interests. I would be more accepting of having to pay a higher income tax if you make a lot of money than a tax per transaction. And the reason for that is that taxing each transaction, it takes liquidity out of the market. And taking liquidity out of the market makes, we are the lubrication for the economy. We make the economy move smoothly because we allow risk to spread across a wider area. And this kind of gets back to whether these products, having too many people in the short vol stuff, having a lot of people shorting volatility is spreading risk across a wider area, which I think is healthy. And when you've got transaction costs getting higher, that takes liquidity out of the marketplace and makes it more risky for the economy in the overall area. Do you think that a simple short position has the same risk as XIV did during the Armageddon? Is there a good chance that your broker will call back your short? I mean, the risk is pretty. Thanks for watching, Matthew. The good thing about being an options trader or being or trading these products is the risk is quantifiable. We can quantify our risk, and I for one am not a huge fan of actually shorting shares of UVXY because I would prefer to use limited risk trades, those being maybe call spread or put spreads. The reason for that, or if you're going to short shares, buy some out of the money calls. So, for example, just to explain that really simply, UVXY here is trading right now 1610. Okay, if you short 100 shares of UVXY, I would be a proponent of like going into the market and buying let's say one Feb 45 call. So you spend, if you're short 100 shares, you could even let's even use a better example, like a 35 call in February. So you're short 100 shares, you go into the market, you spend $82 or let's say $80 to buy a February call. Let me get out of the way here. And this way, your risk is limited. You know that, okay, I'm short these shares, but once it gets to the 35 area, if I buy one of these calls, what that means is that after, if worse comes to worse and UVXY does double in value, once it gets to 35, my risk is off because I have the ability to buy stock paying 35 no matter where. If it goes to 100, I still have the ability to buy it paying 35 if I own this option. And don't, when you ask this, do you think that a simple short position has the same risk as an XIV did during the VIX-mageddon? Don't leave it to chance. Quantify your risk and limit it. You can go into the market and buy a call for every 100 shares you're short, and you can, you don't have to leave it to chance or leave it to like, okay, what's our opinion of how likely is it for a 100 or 200% spike? Don't leave it to my opinion or some expert's opinion. Go in and buy a call to protect yourself. Your overall risk is quantifiable, and because of there being options out here, you can protect it to a specific amount. You can say specifically, I'm willing to lose X amount. I'm not going to lose more than that, and I'm going to protect myself against it. And people get lazy. Nobody's watching over your shoulder. Having a trading account gives you this huge freedom to do whatever you want. It's up to you to be disciplined, because for me as an options market maker, I had people looking over my shoulder. I had risk managers who were actually doing the math and saying, okay, we're going to allow David to take X amount of risk, and if he takes more than that, he's getting a call from us, and we're going to say, take care of this today. You need to be your own risk manager as a trader or as somebody who's putting these positions on, and don't leave it to chance. Go in and protect yourself. If you are selling naked TVIX, there are no calls to buy, but you could buy a call on UVXY against it or VXX against it to protect yourself. I would recommend, if you're thinking about shorting TVIX or UVXY or VXX, I would recommend you taking the time to learn the minimum about options so that you can go in and protect yourself for these things. It's worth you taking the time or paying for somebody for a little bit of a class to protect yourself. Don't leave this stuff to chance. Don't leave it to someone's opinion. It sounds pretty silly if your account blows out and you're like, and you go home to your significant other and say, well, this guy on YouTube told me that it would be okay and it probably wouldn't happen. Right? So don't leave it to chance. This is the same thing with that James Cordier guy who blew up his accounts in natural gas and was all upset. You can take away the chance of that rare thing happening, like, oh, it'll never happen. This can never go up 300%. it could happen. And if you protect yourself and take the steps, then you don't have to worry about it. Now, there is you need to take a risk if you're going to make money, of course. And we all have risk in our life. Something can happen tomorrow that, you can get in a car crash, a safe can fall on you, a safe can fall out of a building onto your head or something. We all have risk. Some of us are more comfortable with taking risk than others. I'm more of a risk taker than some other people I know. And that's just knowing yourself. Thanks for your kind words. Yeah, if you need help, Matthew, on a particular position, I can try to help you with that. But yeah, don't leave it to risk. The percent that you would have to pay to protect yourself is small compared with the numbers you're dealing with in most cases. So, I don't know what the odds. You've seen these guys on the debate, and if you haven't seen the debate, I would recommend go on Twitter and follow these guys if you want to see a healthy debate. And they're probably gonna get riled up just from me doing this. But follow some of these guys on Twitter. Some guys I would recommend definitely following. And you can go to my. You can just go and see who I'm following, but I would recommend following Dynamic Vol. I would recommend following Volatility VIX. One of the guys I interviewed recently, I would recommend following Stevie VIX, which is VIX Contango. I'm just going to pull these up quickly. You can go through them slower when you have a chance if you want. Let me see if this is showing right. All right. I would recommend following Stevie VIX. I would recommend following Trading Volatility. Volatility VIX. And what's the other one? That Pat Hennessy that I was talking about recently. Pat Hennessy. Some of the recent controversy has come around Michael Listman, who I've interviewed on the show. Check out that interview. Michael Listman, check him out on, and there are others, but there's been a debate going on, of course, and people have gotten kind of nasty with each other, which is unfortunate. But as long as my grandfather was a state senator, and he taught me that all publicity is good publicity. So, we want VIX to be in the spotlight. We want it to be something people are talking about. So let's publicize it. Do you think it's okay to step away from your trading workstation to earn more money working? Yeah. I think, yeah, do it. This is like, the whole thing with trading and all this stuff is it's whatever's right for you. And a lot of the strategies which we've put forth are not things that need to be babysat every 5 minutes. And, I'm a position trader, and I leave stuff on for weeks or months at a time. My position right now is out in September. It's there's like 200 and something days till expiration. And yeah, as you're building up stuff and becoming more experienced, yeah, go out and make money. If you listen to Warren Buffett and his philosophies on life, you'll see that the most important thing he talks about, or one of the most important things, I don't mean to be hyperbolic, is having that engine of income coming in that's subsidizing your account. So if you've got an account with X amount in it, let's say you have an account with $10,000 in it, and every month you're able to put 200 more bucks into it. That 200 bucks, if you just left the 10 grand in your account and you just kept adding that 200 bucks every month, your account value is going to grow. If if you're trading and you lose a little bit of money, that's going to offset some of the losses. In the end, it doesn't matter how you get your account to, like, let's say 100 grand in the next 10 years, whether it's from income from other jobs that you're putting in there or making money trading or whatnot. In the end, all that matters is that you save that money. And for me, trading and the philosophy around trading, it all starts with learning how to save money. What we're trying to do is we're trying to accumulate a stash of money, however we can do it. And the most basic way to do that is to have a job and spend less than you make so that you can put money off to the side. Yeah, the stuff to do with trading and how to take that money and turn it into more money is important. But how do you get the money to begin with? You have to work somehow and slowly accumulate, living below your means. And the only way you're going to be able to do that is if you make it a priority to live below your means and build up your money. It doesn't matter how you build up your money, whether it's you had some good trades and stuff, or working that extra job is a way to do it. Not all of us. There's some people who are watching this who either have family money, or they've had a career already and made a lot of money, or they're full-time traders. But there's other people who just either they're in college, they're just starting out, or they're working like the majority of people in a normal job, and they're able to save X amount per week or per month. And, you don't want to squander that money. And certainly if you're coming from a place of less money, you probably want to be somewhat conservative with it and make sure that, that you're only playing. If you want to be risky with a certain amount of money, make sure that money's earmarked for that purpose and it's not your rent money. The last thing you want to be doing, and I've been in this situation before, so I know, is I got to make money this month, otherwise I can't pay my rent. I've worked where trading was my only job, and you don't know if you're going to make money this month. The market conditions are really beyond your control. It's not a good situation to be in. So don't put yourself in a situation if you can help it. People ask me now why I'm not a full-time trader right now. And the reason is because I've been a full-time trader before, and I'd like to get back to that spot sometime soon. But I only started trading again 3 years ago after being gone for like 20 years. And until you really have enough money to do it, it's much better if you have those second jobs, and if you go work those second jobs when you need to be there, go be there and do that. In the end of the day, we're just trying to build up our resources whichever way we can, whether it be trading or elsewise. It's a holistic thing. All right, I've gone really long today, but I appreciate you guys coming on and watching. And the market's looking great today for the short vol. I hope you guys were able to jump on this short at some point here, either yesterday or today. I'm just short from before, so but this is a good thing for the position here. And let's see if you want. I will show my P&L quickly here, but certainly was not a good day yesterday for the old position. And I know there's going to be spikes, and I anticipate this stuff happening. But if we let me show you the P&L here real quick before I go. Let's see, display. And let me get out of the way. Let me move that too. Yeah, so was not a good day yesterday. I'm happy to show bad days because then I don't feel guilty when I show good days. But you can see here, P&L open. Since I put this position on last week, it shows me losing $2,000 on it. And then it shows today's P&L so far up $735. It's showing the overall. It's showing the overall account value here at $5,600. That's down from, it's down by $2,000 in the last 2 days. So that's what you get when you get a vol spike. Fortunately, I didn't cover anything, and this will come back. as we move back lower again. All right. Well, thank you. Thanks, Edward, for coming on. I love being back. This is like my favorite thing to do is these live streams because I can interact directly with people. So thanks for coming here with me, and we will see you the next time on the Short Vol Show live as I cue the music here.